Okay. When you talk about IUL to people, you say, whenever you save money, even if you're saving $1, right? What is the most important thing you're looking for? You're looking for value, right? Even when it comes to grocery shopping or anything like that, value is so important, right?
Yes.
So when it comes to value in building wealth, that's what we do. We help people build value on wealth, or how to save that $1. So for people that are looking for value for their money in the financial industry, what does that mean? If you want value for your money in the financial industry, what does that mean? What does your money have to do for you?
It has to work for you.
It has to work for you. So it has to grow for you. It has to be safe from any loss at all. It should have certain tax advantages, right?
Yes.
And it should also take care of you. Okay. So when you think about it, most people in this country, they put their money in three places. They put their money in the banking industry, $19 trillion industry. They put their money in the securities industry, which is the stock market.
Yes.
It's a $12 trillion industry. Then they put their money into real estate. Real estate's a $9 trillion industry. Okay. Now, if I'm working so hard to save this extra dollar after paying all my bills, or I meet a nurse who, after paying all of her bills, she can only save $200 a month. Where is she going to get the most value? Right. So let's test it out. In the bank, when you're looking for growth, how much growth is she going to get in the bank?
Nobody. That's 0.00001.
Yep.
So bank pay you nothing.
Exactly. Pays you nothing. But if you look at inflation, inflation's at what? Inflation's at 7%.
To wipe you out.
So
you are losing money.
Exactly. And we're all losing money in the bank. But then why do we put our money in the bank? Because the money is safe. Right? It's protected by up to $250,000 by the FDIC. And who's the FDIC?
That's the Federal Deposit Insurance.
It's an insurance company. So even the bank uses insurance, right?
Yep.
If we talk about tax advantages, every single year when you keep money in the bank, you pay tax now. They file taxes on your money.
Yes.
And long-term care. If I ever need help with eating, bathing, going to the bathroom, sorry, my typing is bad today. Bathroom, changing my clothes, even putting on your shirt, right? Continence, and transferring in and out of a car, out of your bed, onto a chair. If we can't do these things, I go to the bank. What is the bank going to do for me for long-term care?
The bank cannot do anything. If they borrow you money, then you have to go and spend your own money.
Yeah.
They can't do anything.
Let's say like I break my leg and I go in the bank. They're going to say, did you hit your head too?
Yes.
Because this is not a hospital. This is a bank. We can do nothing for you, right? That's why smart people try to move their money here. Because they know they have to beat inflation. Just to make positive, they have to make over 7%.
Yes.
Right? So they put their money here in securities. Securities is what? Stocks, bonds, options.
Mutual funds.
Yep. Mutual funds. 401k. Right? So they get growth, right?
Yes.
They have growth in these accounts. They can make a lot of money. But what about the safety? Are there guarantees that they're not going to lose money? There's no guarantee.
No guarantee.
No guarantee.
The only guarantee there is bond, but it's 2% they pay.
Even the value of the bond, when you sell the bond, that's depending on the economy. So even though if you're making 2% your bond, the bond itself is subject to interest rate hikes, taxes.
Yes.
You don't pay tax right now in most of these situations. You pay tax later.
But they'll hit you whatever your interest rate is there.
Yep.
Like a Roth IRA. Yeah.
Like your traditional IRA. And then the last thing is the long-term care. Does your 401k pay you extra money if you get hurt or sick? No, you use your own money.
Yeah.
So the securities industry does one thing really well, and that's grow your money. Banks keep your money safe. Securities keep your money growing. If we talk about real estate is used for hundreds of years to build wealth. Real estate has made more millionaires in America than anybody else. Okay. But just simply looking at if this person has $200 a month to save, what kind of home can they afford for $200 a month?
No home.
In Georgia.
They can't even afford a land. Not even a land. They can't buy an empty
or a closet.
Nothing.
Yeah. And with interest rates so high, young people can't even afford it also. So it's almost untouchable for most Americans. So where is the other avenue? This is what we specialize in, right? And that's the insurance industry. The insurance industry has been specializing in wealth building since 1997. with this product called IUL,
Yes.
right? Now, what is IUL and how does IUL work? To give you all the value, I'll draw it right here. And this is how you're going to show the product. You do 4 boxes, okay? 4 boxes. So let me draw the 4 boxes. So like I said, for you to get real value in the money, you need growth. You need guaranteed safety from market loss. You need tax advantages in case the government increases taxes. And also you need something for long-term care. What's going to take care of you if you need help, right? So with this one company, with Transamerica, there's 2 products, okay? One product is called the FFIUL, which is this, okay? You can keep this, this is yours, okay? Every single month, how does this product work? Let's say that nurse, all she has is $200 to save every month. So this $200 that she's saving every month, she's going to give it as a premium, Now it's no longer just money. Now it's a premium. And this premium goes into an insurance company. This company is called Transamerica. Every single month, this company is going to invest her money for her into an index, right? Insurance companies are the most secure places to put your money. It's called a tier 1 asset. For most major banks and stock companies, a tier 1 asset is the most secure form of investment that you can have. And guess what? Life insurance is a tier 1 asset because insurance companies cannot buy stocks. They cannot buy options. They do some options trading, but usually they just put their money in bonds and in indexes. So what major index? S&P 500.
Or
Euro stock, so many, right here, yep. Okay, when this index grows by 10% this month, it's linked to your IUL policy, right? But it's not in the market. See, when the market grows here 10%, the key word is you get credited. You get credited the exact amount, 10%. So if market grows by 10%, you get credited 10%. If market grows by 15%, you get credited up to 13%. That's the cap. That's the max you can make every month, 13%. So whenever the market grows, you can earn crediting up to 13% monthly. Now, why is crediting so important? Because what goes up can also go down. If market crashes by 10%, 15%. Here you have guaranteed safety. You have a guaranteed floor. A guaranteed floor credit of 0.75. 0.75%. So if market crashes by 10%, you get credited 0.75. If market crashes 20%, you get credited 0.75. You never earn less than the minimum credit of 0.75, right? And the average interest rate for the past 20 years, if you look here, 8.15%, right? Over 8%. And what do you need just to beat inflation? 7%.
Yep.
Okay. Now, why does it have to be underneath the umbrella of insurance? Because that's the last place in America that you can put money in outside of a Roth IRA, take out the money completely tax-free, right? All of this money is completely tax-free when you pull it out, right? That's called under 3 IRS rules, Section 72E, Section 101A, and Section 7702 of the Internal Revenue Code.
Can you put IRS on top of it?
Yeah. Allow you to grow your money tax deferred, access your money tax free, and give your this is actually to grow your money tax. This is to defer, to grow your money tax deferred. This is to access your money tax free. And this one is to pass it to the next generation, the life insurance aspect, tax free. Okay. Now it's not all positive. Here's the negative. The negative is, what if I want to take my money out? So the negative is, if you want to access, let's say you have $100,000 of cash value built into your policy, 100K, and you want to access this money in the first 10 years, you have to pay the insurance company an interest rate. And in that first 10 years, that interest is 0.75%. That means if you want to access this $100,000, you just have to pay the insurance company $750. That's it, one time. Okay. But if you compare this to a 401k, if you do the same thing in a 401k, and access this $100,000, You pay a 10% penalty.
Yeah.
That's 10K gone. Then you pay income tax. And if you're making $100,000 income tax, that's around 28%. So total, you would have paid 38,000. 38,000 to access the same money. And that's just the bad. After the 11th year, guess what? Now the interest is zero. Zero taxes, zero interest. So you can use this for college. You can use this for retirement. You can use this for business planning. I use this for buying businesses. I use it to buy a liquor store. I'm using it now to buy a pet store for my wife, right? You can play with the money.
Yeah.
Okay. Last thing is long-term care. This is huge, right? If you ever need help with all those activities of living, how much would it cost to have someone take care of in Georgia?
It's a lot. Maybe say 10,000 a month.
Right now, it's around 5 to 7.
Okay.
But in 10, 20 years, yeah, it'll be, and right now you're young, you don't need it. So in 10 years, yeah, it'll be 10,000. Right now, 5 to 7,000 a month if you need long-term care. If you don't have long-term care, where does this money come from?
The person will go bankrupt.
Your bank, your stocks, and your real estate. Those other 3 places. So to protect those places, you need long-term care. We call it asset protection. It's not just protecting you, it's protecting the other assets that you have. Your home, the liquidity in your home, your bank, your retirement. All of this can go away just like that if you don't have long-term care. And right now, 14 states are implementing a new long-term care tax. So for every $10 worth of income that you make, you have to pay the government 50 cents in additional income tax if you do not have long-term care. And so whether you make $500,000 or $50,000, we pay the same taxes, right? 50 cents for every $10, right? You pay more taxes than me because you make $500,000, right? But then the benefit, we only get $36,500 in total benefit. So if long-term care costs this much, and this is what the government's giving me, how long will this last? 6 months?
Yep.
7 months? So this lady who's paying $200 a month, this nurse who saved $200 a month, she has a IUL policy. Within this policy is a bank account growing at up to 13%, protected at 0.75%, accessible, completely tax-free. But because it's life insurance, if she ever needs if she needs long-term care, what happens? After a 90-day waiting period, where a nurse checks on you, sees if you need help, they stop her from paying. Her premium stops. They halt her premium. And after this 90-day waiting period, let's say she's 40 years old. If she's 40 years old, paying $200 a month, you could probably get a $250,000 policy. Okay? She will get 2% of a $250,000 sent to her every month. How much is that? $5,000.
Yes.
Every single month directly into her bank account, tax-free. So what is IUL when you really think about it? What is IUL when you really think about it? This is called the X curve. This is when you're young. This is when you're old. This is your wealth curve, and this is your responsibility curve. When you're young, you have a lot of responsibility, very little wealth, right? You're newly married, you have a brand new house, you have a new house, new wife, you have kids to take care of. That's called income replacement. You have debt, you have a car, right? Other loans, student loan. Then you have education for the kids. So when you're young, what does an IUL do? Just in case this person is not here anymore, an IUL will act as insurance. And it will, when I'm here anymore, it'll pay off the house, take care of the family's income, pay off your debt, and send your kids to school. That's called taking care of the family. Now, let's say as you get older, this will also start building wealth, tax-free wealth for you. So once you're older, this becomes your tax-free retirement and will pay you every single year tax-free, right? As you get older. And in between, if something happens where you're half dead, half alive, this will pay you long-term care and it'll take care of you. This is called the one-stop shop. It's good to have a bank. It's good to have a 401. It's good to have a. It's also good to have this. Okay. Any questions on that?
No.
Okay. So that's the first product. The second product is for people that want to make a lot of money in the policy, and for young kids, because kids under 18 they cannot get long-term care.
Yes.
Right. So there's a new product called FCIUL. The first one was which one? FFIUL.
Yeah.
That's this one. This one is FC. So same exact thing. If I draw these 4 boxes here, the growth. In the other product, this cap was how much? 13%.
Mhm.
In this product, there's no cap.
Yeah. So whatever the market does, the
Mhm.
market go crazy.
Market goes crazy.
You get that's all the growth.
Yes, but it's even better than that because you also have something called a 200% par rate. You have a 200% par rate. What is par rate? Par rate means how much money is working for you.
Mm.
So when you invest $100 in the market, you have a 100% par rate.
Mm.
So if market grows by 10%, that means you made $10.
Mm.
But if you get a 200% par rate, that means companies giving you an extra $10.
$10, yeah.
So let's say there's no cap, 200% rate. If market does 4%, how much does your client make?
8%.
8%. If market does 15%,
They make that
30%, and no cap. So this is really for making money. And guess who we've partnered with this product? Fidelity.
Whoa.
So we're one of the few companies partnered with Fidelity on this contract. No other company has it, right?
Fidelity and Vanguard, they are the best in okay.
Yep. And so they've partnered with Transamerica. It's managed by Fidelity. Okay. Now, safety. Safety. In the other product, what was the floor?
On the safety.
0.75.
Yeah.
0.75.
Mm-hmm.
Here it's also safety, but it's less. It's 0.25. Still above zero, but you're still guaranteed to make 0.25.
25, yeah.
But no cap.
It's better than the bank. You can't get
0.25 at the bank anyways. Yeah. So this is a very powerful product. Okay. Now the premium for that same 40-year-old, nurse, it's not going to be $200. The target premium's a little bit higher at this product because it's for making money. So for her, the same product would be around $240.
That's not much.
Instead of $200, $240.
So a 40-year-old can have this?
Yeah, a 40-year-old can have this. But why do I choose not to sell? You have to understand why. This is why. You can sell it to a 40-year-old. This is why I would sell them both.
Mm-hmm.
If they need to buy 200,000, I'd sell them 100 of this, 100 of this. Why?
Okay.
So this has good growth. This has safety. This is also tax-free. Tax-free. Okay. This has something called an indexed loan, which is crazy. Okay. I don't want to get too far into it, but this is an indexed loan where you can make money on the loan. Remember, in this policy, in the first 10 years, you pay 0.75.
Yeah.
After 11th year, you pay 0. In this product, what happens is they charge you 5% every year, but then they credit you whatever the index return is on the loan. So let's say that you pull out $100,000. You pulled it out. You're spending the money tax-free. They charge you 5,000. Now this year market does 4%. You make 8%. So what's the difference between 8 and 5? 3. You made $3,000 on your loan, and the cash value is growing too by 8%. Cash value grew by 8%, but you also made another 3,000. It's called a leveraged loan, which you can only do in IUL. You cannot do that in whole life. Okay. Now the bad thing is this. The bad thing in this product is there's no long-term care.
Okay, yeah, that's why you say so.
Because you don't want to leave a family without long-term care.
Yeah, especially 40-year-old.
So for what I do normally is I sell the parents FFIUL, and then I sell kids